Hello viewers and welcome back to Dukascopy TV. Up next in the studio, I'm joined by Pierre Vassart of Dukre Asset Management. Pierre, thank you very much for coming in today.
Thank you, Natalie.
No problem at all. Now, if we take a historical look at monetary creation from central banks, historically markets have gone up. Can you expand on this a little bit more for us?
Yes, in fact, the money creation, this massive creation of liquidity by central banks today is not a new phenomenon. In the 1920s, between 1920 and 1922-23, three central banks in Europe did this massive monetary creation also. There were the central banks of Germany, Austria, Poland, and they were also preceded by France and Italy. And basically what happened is a two-stage process. In a first stage, equity markets go up because money is abundant and there is no other place to invest. So investors go and flood to the equity markets. So equity markets went up all around the world, and even the US markets, which did not do such a massive effort in creating money at that time, was the market that came up the most because of the attractive conditions of US companies. In a second stage, however, starting in 1928 and 1929, then values were crashed. So in other words, a top happened, and a top happened because valuations of companies got far beyond the intrinsic value of these companies. And values were destroyed to the tune of around 60 to 70% for all markets.
So if we take that historical view and then we compare that with now, conditions are different, surely?
Yes. The big difference today is that we see a risk of deflation in our economies, whereas at that time the monetary creation created inflation and even hyperinflation in Germany, Poland, and Austria. So this is the big difference, where today even sectors like TV sets, pharmaceutical products, mineral waters, and technological products get pressure on their selling price.
What should investors be doing then?
I think investors should take a prudent approach. They should not be carried away with this euphoria about stock markets and think that stock markets are the only asset class to be in. What they should do, they should try to identify effective absolute return strategies. And by that I mean strategies which are able to generate positive returns irrespective of equity markets and irrespective of stock market trends. If I take an example here, for example, in 2008, you can see that even in 2008, stock markets in the green bar witnessed a drop of 40%. That hedge fund index, on average, they lost 23%. However, those strategies that were absolute return strategies, like for example the Reflex Discretionary, which is now on the DB Select platform, they were positive. And this is not by chance, because you can see that in 2011, which was another down year for stock markets, that you see also negative performance for stocks and for the average index in general. But some programs which work with a truly absolute return philosophy, they try to generate a positive return year after year, which was the case again for the Reflex program. If we now look at a medium-term performance comparison, if we look at not only a full investment cycle between down years and bullish years, you can see that absolute return programs, if they are well managed, they can produce a satisfactory return, whereas the stock market and the index of hedge funds, they take a long time to recover. In summary, what I think investors should do, there has been a tendency in recent years to talk about risk on, risk off philosophies and alternative movements between back and forth into equities. I think now the time has come for a third way, which is the de-risking strategies. The de-risking strategies means that investors should take money gradually out of stocks. They should take money out of bond markets, which are also fairly richly valued, and they should put in absolute return strategies as long as they demonstrate an ability to preserve capital in down markets.
Pierre, thank you very much for coming and sharing your thoughts on de-risking strategies with us. Thank you very much.
Thank you. Thank you, Natalie.
That's all we've got time for right now, but don't go away. Dukascopy TV will be bringing you all the latest in FX analysis and updates. From me, though, it's goodbye for now.